Before we dive in, a quick and important disclaimer. I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and informational purposes only and does not constitute financial or legal advice. You should always consult with a qualified professional before making any decisions regarding your insurance coverage. Your financial situation is unique, and the strategies discussed here may not be suitable for your specific needs. The letter arrived on a Tuesday. I remember the stark black font on cheap paper. Important information about your auto insurance policy. I almost threw it away with the junk mail, but I opened it and my stomach dropped. My premium for the exact same car and the exact same coverage was increasing by 32%. 32%. I hadn't had an accident in over a decade. My driving record was spotless. No tickets. No claims. Nothing had changed. So why was I suddenly being punished? I felt a surge of anger, then confusion. I was a good driver. I paid my bills on time. Wasn't that the deal? It turns out the deal I thought I had was a complete illusion. That single piece of mail sent me down a rabbit hole that fundamentally changed how I view the entire insurance industry. And it revealed a system that is specifically designed to profit from your confusion. And what I discovered is exactly what I'm going to share with you right now. Because there is a 99% chance you are overpaying for your car insurance, and you don't even know it. This isn't just about finding a cheaper rate. This is about understanding the game so you can finally win it. We're going to dismantle the jargon, expose the hidden trapdoors in standard policies, and build a bulletproof strategy to get you the absolute best coverage for the lowest possible price. By the end of this journey, you will never look at an insurance bill the same way again. You'll have the confidence to negotiate, the knowledge to spot a bad deal from a mile away, and a clear, actionable plan to save hundreds, maybe even thousands of dollars a year. So where do we start? We start at the bottom. The absolute foundation of auto insurance in the United States, state minimum liability coverage. You've seen the ads. Get legal for just $1 a day. Or state minimum coverage starting at $19 a month. It sounds incredible, right? The absolute cheapest way to legally get on the road. And technically it is. Every state, with the exception of New Hampshire, legally requires you to carry a certain amount of liability insurance. This is not for you. Let me repeat that, because it's the most misunderstood concept in auto insurance. Liability coverage is not for you. It doesn't fix your car if you're in an accident. It doesn't pay your medical bills if you're hurt. It exists for one reason and one reason only: to pay for the damage and injuries you cause to other people and their property. The government mandates this so that if you crash into someone, you don't leave them with a totaled car and a mountain of medical debt that they, or the taxpayers, have to cover. You'll often see this coverage written as a series of 3 numbers, like 25/50/25. This looks like a secret code, but it's actually pretty simple. Let's break it down. The first number, the 25, represents $25,000. This is the maximum amount your insurance company will pay for bodily injury to a single person in an accident you cause. If you hit a pedestrian and their medical bills are $40,000, your insurance pays the first $25,000. The remaining $15,000? That's on you. They can sue you for it. They can garnish your wages for it. That debt becomes your problem. The second number, the 50, represents $50,000. This is the maximum amount your insurance company will pay for bodily injury for the entire accident, no matter how many people are hurt. Let's say you swerve on a wet road and hit a minivan with a family of 4 inside. All 4 are injured. Your insurance will pay out a total of $50,000 to be split among them for their medical bills. If their combined bills are $100,000, your policy caps out at $50,000, and you are personally on the hook for the other $50,000. The third number, that final 25, represents $25,000 for property damage. This is what pays to repair or replace whatever you hit, whether it's another car, a mailbox, a storefront, or a city light pole. Now ask yourself, have you seen the price of a new car lately? The average new car price in America is hovering around $48,000. A new Ford F-150, one of the most common vehicles on the road, can easily top $60,000 or $70,000. That state minimum $25,000 property damage limit? It wouldn't even cover half the cost of replacing a brand new Toyota Camry. If you total someone's new truck, your insurance pays $25,000, and you get a bill from their lawyers for the remaining $45,000 plus legal fees. Do you see the problem here? State minimum insurance is a financial time bomb. It allows you to legally drive, but it offers you a terrifyingly low level of protection in the modern world. One single, moderate accident can lead to financial ruin. A lawsuit can wipe out your savings, your investments, and follow you for years. So why do insurance companies push it so hard? Because it gets you in the door. It's a low-price leader. They sell you the cheapest, most inadequate product possible, knowing that many people will never question if it's actually enough. They are selling you a ticket to be legal, not a shield to be protected. Think of it like this: building a house to the absolute bare minimum of the legal building code. Yes, the structure is technically legal to live in. It has walls and a roof, but it has no insulation, the windows are single pane, and the wiring can barely handle a microwave. The first cold snap or major storm and the whole thing falls apart, leaving you exposed. That is state minimum insurance. It meets the letter of the law, but it completely fails the test of real-world risk. The scary part is that millions of Americans are driving around with these policies right now, thinking they're covered. They believe that because they pay a bill every month they're safe. But the protection they've purchased is a mirage. It's a paper-thin shield against a world of six-figure medical bills and $100,000 lawsuits. The peace of mind they think they have is an illusion, one that will be shattered the moment they hear the crunch of metal and the screech of tires. So the first and most crucial step in finding low-cost auto insurance is not to ask, "What is the cheapest policy I can buy?" The question you must ask is, "What is the absolute minimum coverage I need to actually protect my assets and my future?" The goal isn't just to be legal. It's to be smart. It's to build a fortress around your financial life, so that one bad day on the road doesn't destroy everything you've worked for. Understanding this distinction, the chasm between being legally compliant and being financially secure, is the key that unlocks everything else. It reframes the entire conversation. We're no longer just shopping for a price tag. We are shopping for security. We are shopping for peace of mind. And believe it or not, you can get real meaningful security for far less than you think. You just have to know where to look and what to ask for. The rock-bottom prices are often a trap. The real savings, the real value lies just a little bit higher up the ladder, in a sweet spot of coverage that gives you robust protection without breaking the bank. And that is exactly where we are going next. We've established the floor, the absolute bare minimum. Now, we're going to build on that foundation and design a policy that actually works for you in the real world. So let's start building. You've got your state-mandated liability coverage. You are officially legally on the road. But I want you to pause and think about something for a second. That policy we just discussed? It has a giant gaping hole in it, a hole the size of your own car. Because liability insurance, by its very definition, is for other people. Pays for the car you hit. It pays for the injuries of the people in that car. It protects your assets from being taken in a lawsuit. It does absolutely nothing for you, or for the vehicle you are driving. Let's imagine a simple, everyday scenario. It's winter. You're driving home, maybe a little too tired. You hit a patch of black ice you didn't see, and your car spins out and slams into a guardrail. You're okay, thank goodness, but your car is a wreck. The front end is crumpled. You call your insurance company, give them your policy number, and they tell you something terrifying. "We're sorry, but your policy doesn't cover this." Why? Because you didn't hit another person. You hit an inanimate object. There's no one to be liable to. You are on your own. The tow truck, the repairs, or worse, the cost of a new car. That all comes directly out of your pocket. For most of us, that's a financial disaster. This is where the first and arguably most important building block of a real insurance policy comes into play. It's called collision coverage. Collision is exactly what it sounds like. It pays to repair or replace your own car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, a fire hydrant, even a pothole that completely wrecks your axle. If you are in an accident and it is deemed your fault, this is the coverage that fixes your car. If you hit that patch of ice, collision is what saves you from a $10,000 repair bill. Now, when you add collision, you're also going to be introduced to a new term, the deductible. This is a word that confuses a lot of people, but the concept is incredibly simple. A deductible is the amount of money you have to pay out of pocket before the insurance company starts paying. Think of it like a copay at the doctor's office. Let's say you have a $500 deductible, and you get into an accident that causes $4,000 of damage to your car. You pay the first $500 to the auto body shop, and your insurance company pays the remaining $3,500. If the damage was only $400, you just pay it yourself because it's less than your deductible. You get to choose your deductible amount. usually ranging from $250 up to $2,000 or more. And here's the key takeaway, the secret to balancing cost and protection. The higher your deductible, the lower your monthly premium will be. Why? Because you're agreeing to take on more of the initial financial risk yourself, so the insurance company rewards you with a lower price. The question you have to ask yourself is brutally honest. If I got in an accident tomorrow, what's a lump sum of cash I could realistically come up with without going into debt? If that number is $500, choose a $500 deductible. If it's $1,000, you can choose that and enjoy a lower monthly bill. But never ever pick a deductible that's so high you couldn't actually afford to pay it. That defeats the entire purpose of having the insurance in the first place. So we've added collision. Our policy is looking much better. We're protected if we cause an accident. We're safe, right? Almost. Let's throw another scenario at you. You park your car at the mall. You come back an hour later and find someone has keyed the entire side of it. Or a massive hailstorm rolls through your town and your car now looks like a golf ball. Or even more common, you're driving down a country road at dusk and a deer jumps out in front of you. You call your insurance company. Is this covered by your new and improved policy? The answer is no. Why? Because none of those events were a collision in the traditional sense. Vandalism isn't a collision. Weather isn't a collision. Hitting an animal, surprisingly, is not considered a collision by insurance companies. For these events, you need the second major building block of protection. It's called comprehensive coverage. Some companies call it other than collision coverage, which is actually a more accurate name. It's a bucket that catches almost everything else that could possibly happen to your car. Theft, vandalism, fire, flood, hail, falling objects like a tree branch, and yes, hitting a deer. Comprehensive is what fixes your car when the damage isn't your fault. And it isn't anyone else's fault either. It's for the random, unpredictable chaos of the world. Just like collision, comprehensive coverage comes with a deductible. And just like collision, you can choose a higher deductible to lower your premium. Many people choose to have the same deductible for both just to keep things simple. These two coverages, collision and comprehensive, are often sold as a pair. Together, they are what people are usually talking about when they say they have full coverage. While that's not an official term, it generally means you have a policy that covers the other guy, liability, your car in an accident, collision, and your car from almost everything else, comprehensive. Now you might be thinking, this sounds expensive. I came here for low-cost options. And that's a fair point. Adding these two coverages will increase your premium. There's no way around that. But the question isn't, does it cost more? The question is it worth it? Here's the simple framework to decide. Look at your car. How much is it worth? If it was stolen or totaled in an accident tomorrow, would you have the cash on hand to go out and buy a similar car? If you drive a 20-year-old beater that's worth maybe $1,000, and you have that in savings, then maybe you don't need collision and comprehensive. You can self-insure, meaning you accept the risk yourself. But for the vast majority of people, their car is one of their most valuable assets. They can't afford to just write it off. If you have a car loan or a lease, the decision is made for you. Your lender will require you to carry both collision and comprehensive to protect their investment. But even if you own your car outright, if you can't afford to replace it, you can't afford to go without this protection. The extra $40, $60, maybe $80 a month is the price of peace of mind. It's the price of knowing that a single moment of bad luck won't completely derail your financial life. So now let's look at the policy we've built. We started with the legal minimum, which only protected other people. Now we've added a shield around our own vehicle. We're protected if we crash it, and we're protected if a tree falls on it. This is starting to look like a policy that actually serves us. But there's still a huge, menacing threat out there on the road. A threat that can leave you with crippling medical bills and no way to pay them, even if an accident is 100% not your fault. We've insured against our own mistakes, and we've insured against acts of God. But what happens when the person who smashes into you has made the irresponsible choice to drive with no insurance at all? Or they have that bare-bones liability policy we talked about, and your hospital bills are 10 times what their policy will pay? It's a nightmare scenario, and it happens every single day. And that is the final critical piece of the puzzle we are going to solve next. The solution is a type of coverage that most people either ignore, misunderstand, or deliberately decline to save a few dollars a month. And in doing so, they are leaving the back door of their entire financial life wide open. This coverage is your personal financial bodyguard on the road. It's called Uninsured and Underinsured Motorist Protection. And it is, without a doubt, the single most important insurance you can buy that isn't legally required. Let's break that down. Uninsured and underinsured. They are two sides of the same coin. Uninsured motorist coverage protects you if you're hit by someone with no insurance at all, a ghost, or even more commonly, if you're the victim of a hit and run, and the other driver is never found. From your insurance company's perspective, a driver they can't find is a driver without insurance. Underinsured motorist coverage is what protects you from that nightmare scenario we just talked about. It's for when you're hit by someone who has insurance, but their liability limits are pathetically low. So low they can't even begin to cover the cost of your injuries. Let me paint you a picture. Let's invent two people. We'll call them responsible Rachel and minimum payment Mike. Rachel does everything right. She works hard, saves her money, and she's a safe driver. She listened to our last segment and understood that the state minimum liability isn't enough, so she has a decent policy. She also has a good job, but if she can't work, she doesn't get paid. Mike, on the other hand, just wants the cheapest piece of paper possible to keep the police off his back. He drives an old, beat-up sedan and he buys a state minimum policy. Let's say the state minimum for bodily injury is $25,000 per person. That's all he has. One afternoon, Rachel is sitting at a red light, minding her own business. Mike is texting and driving. He never even sees the light. He slams into the back of Rachel's car at 45 miles per hour. The crash is violent. Rachel's car is totaled. But that's just the start of her problems. She suffers a serious back injury and a broken leg. She's rushed to the hospital in an ambulance. She needs surgery to set the leg, an MRI for her back, and she's told she'll need months of physical therapy. She won't be able to work for at least 3 months. The bills start rolling in. The ambulance ride, $2,000. The emergency room visit, $5,000. The surgery and hospital stay, $60,000. The physical therapy, $20,000. And the lost wages from not being able to work for 3 months? Another $15,000. All told, Rachel's damages, just the direct quantifiable ones, add up to $102,000. And this doesn't even account for the months of pain, the stress, the inability to play with her kids, or the permanent limp she might have. The police report is clear. Mike was 100% at fault. So, his insurance company steps up, and they write Rachel a check for $25,000, their maximum liability. That's it. That's all they have to pay. They close the case. Rachel is now left with a $77,000 hole. A hole created by someone else's recklessness. She could try to sue Mike personally, but what is she going to get? The guy driving a $1,500 car with minimum insurance doesn't have $77,000 sitting in the bank. You can't get blood from a stone. So what happens? That $77,000 now becomes her problem. It goes to collections. It ruins her credit. It wipes out her savings. It becomes a source of constant stress and anxiety. Her life is turned upside down financially and physically because of a 5-second mistake made by a stranger. This is the reality thousands of Americans face. But let's rewind. Let's imagine a different story. In this version, when responsible Rachel was setting up her car insurance, her agent asked her a question. Would you like to add underinsured motorist coverage? Instead of saying, no, I want the cheapest plan, Rachel asked, what does that do? Her agent explained it. It protects you from people like Mike. You choose your own limits. If you get hit by someone who doesn't have enough insurance to cover your bills, we, your own insurance company, will step in and cover the rest, up to the limit you choose. So Rachel, being responsible, decided to match her underinsured motorist limits to her own liability limits. She chose $100,000 of coverage. It cost her an extra $8 a month, the price of 2 fancy coffees. Now let's play the accident scenario again. Mike still slams into her. The bills are still $102,000. Mike's insurance still only pays $25,000, but now the story has a different ending. Instead of facing financial ruin, Rachel files a claim with her own insurance company under her underinsured motorist policy. Her company looks at the math. Total damages, $102,000. Paid by at-fault driver, $25,000. The remaining gap, $77,000. Because Rachel had the foresight to buy $100,000 in coverage for just a few extra bucks a month, her own insurance company writes her a check for the remaining $77,000. Her hospital bills are paid. Her lost wages are covered. She can focus on her physical recovery without the terror of impending bankruptcy. That $8 a month just saved her from financial catastrophe. Now I can hear what some of you are thinking. But wait, I have health insurance. Won't that cover my medical bills? And the answer is yes, partly. But it's a dangerously incomplete solution. First, your health insurance has deductibles, copays, and out-of-pocket maximums. You'll still be on the hook for thousands of dollars. Second, and this is the giant flashing red light, your health insurance does not pay you a single penny for your lost wages. It doesn't compensate you for the pain and suffering you endure. It doesn't help with the follow-up care or modifications you might need to your home if you have a permanent disability. Underinsured motorist coverage can cover all of that. It fills the massive gaps that health insurance leaves behind. Another thing people say is, but isn't car insurance mandatory? Everyone should have it. Should is the key word. The Insurance Research Council estimates that nearly 1 in every 8 drivers on the road in the United States is completely uninsured. 1 in 8. That means on your average commute you will pass dozens, if not hundreds, of drivers who have zero insurance. And that statistic doesn't even account for the tens of millions more, the minimum mics, who are driving around with policies so flimsy, they might as well be uninsured if they cause a serious accident. When you decline uninsured and underinsured motorist coverage, you are betting your entire financial future that you will never cross paths with any of those millions of drivers. It is a terrible bet to make. This is the fundamental secret to building a smart, low-cost insurance plan. It's not about just finding the lowest possible number. It's about understanding where you can't afford to cut corners. You are buying this to protect yourself from financial ruin. And the single biggest threat to your financial well-being on the road isn't you hitting someone else. It's someone else hitting you, and they turn out to be one of the millions of people who couldn't care less about their responsibility. So I want you to do something. Sometime today, pull up your own auto insurance policy. Look for the declarations page. Find the line item that says uninsured/underinsured motorist bodily injury, or UM/UIM. Look at the numbers next to it. If those numbers are low or worse, if it says declined or rejected, you need to call your agent immediately. This is the one coverage where spending a few extra dollars provides an astronomical return on investment. It's the armor you wear to protect yourself from the very people this video series is trying to help you avoid becoming. You've now built a financial fortress to protect your body and your bank account from other drivers. But what happens when the accident is your fault? Or what if it's nobody's fault? A tree falls on your car during a storm. A deer jumps out on a country road. Your car is stolen from a parking lot. Your liability coverage won't help you. Your uninsured motorist coverage won't help you. That's when 2 other words become the most important in your policy. And they are the 2 most commonly misunderstood parts of any auto insurance plan: collision and comprehensive. These are the 2 coverages that are all about protecting one thing, your own vehicle. See, everything we've talked about so far, bodily injury liability, property damage liability, that's all about paying for the mess you make for other people. It's noble, it's required by law, but it does absolutely nothing to fix your own crumpled bumper or shattered windshield. Collision and comprehensive are selfish in the best possible way. They are the coverages that protect your investment, your ride to work, your freedom. And understanding the critical difference between them is the key to not getting financially wiped out by one single bad day. Let's start with collision. The name says it all. This coverage pays to repair or replace your car if it's damaged in a collision with another object. And I mean any object. Most people think it just means hitting another car. And yes, it covers that. But it also covers you backing into a light pole in a parking lot. It covers you swerving to miss a squirrel and hitting a curb, messing up your axle. It covers you sliding on a patch of ice and nudging a guardrail. If your car is in motion and it makes contact with something that damages it, that's a job for collision coverage. Let me tell you about a guy named David. David was a good driver. 20 years, not a single at-fault accident. He owned his 10-year-old sedan outright. It was worth about $8,000, a car he was proud of. To save money, he carried a liability-only policy. Why pay for collision? He thought, I'm a safe driver. If someone hits me, their insurance will pay for it. And he was right about that. But he overlooked one tiny detail. He's not the only factor in an accident. One rainy Tuesday, he was on the freeway. Traffic slowed suddenly. He braked, but the guy behind him was following too closely on bald tires. That car slammed into David, pushing him into the car in front of him. A classic chain reaction. The police came, and the driver who started it all was found 100% at fault. So David's logic should have held up, right? The at-fault driver's insurance should pay for everything. Here's the problem. The at-fault driver had the absolute bare minimum state liability limit for property damage. In his state, it was just $10,000. The car David was pushed into was a brand new luxury SUV. The damage to that SUV's high-tech bumper and sensors alone was over $9,000. That left less than $1,000 of the at-fault driver's policy to fix David's car. The estimate to repair David's front and rear end damage? $7,500. Because he didn't have collision coverage on his own policy, there was nowhere else to turn. He could sue the other driver personally for the difference, but the kid was 22 working a minimum wage job. You can't get blood from a stone. David was faced with a horrible choice. Drain his savings to fix his car, or try to sell his wrecked $8,000 asset for a couple grand in scrap. All because he wanted to save $40 a month. If he had collision coverage, his own insurance company would have paid the $7,500 to fix his car, minus his deductible. Then, his insurance company, with its army of lawyers, would have gone after the at-fault driver to get that money back. He would have been whole. Instead, his low-cost insurance plan cost him thousands. Collision coverage is your safety net for the physical act of driving. But what about all the things that can happen to your car when it's just sitting there? What about the chaos of the world that has nothing to do with your driving skills? That's where the second hero of our story comes in. Comprehensive coverage. Think of comprehensive as other than collision coverage. It's for the bizarre, the unpredictable, the acts of God and the acts of idiots. A hailstorm pummels your car, leaving it looking like a golf ball. Comprehensive. A deer decides to play chicken with you on a country road at 60 miles per hour. That's not considered a collision with an object in the same way a pole is. It's an animal, so it falls under comprehensive. A windstorm knocks a massive tree branch onto your roof. Comprehensive. Someone steals your car from your driveway. Comprehensive. Vandals smash your windows or key your paint job. Comprehensive. A flash flood turns your street into a river and swamps your engine. You guessed it. Comprehensive. It's the part of the policy that protects you from the sheer randomness of life. And so many people skip it thinking, I live in a safe area. We don't get floods or hail here. They focus on the big dramatic events and forget the mundane. The most common comprehensive claim in many parts of the country isn't a tornado or a theft. It's a simple cracked windshield from a rock kicked up by a truck on the highway. In many states, a windshield replacement is covered under comprehensive, sometimes with a $0 deductible. Without it, you're paying $500, $1,000, even $1,500 out of pocket for a new windshield, especially with all the new camera and sensor technology embedded in them. So, the big question is, do you actually need these two coverages? The answer isn't the same for everyone. It comes down to three critical questions you have to ask yourself. First, do you have a loan or a lease on your car? If the answer is yes, then the decision is made for you. The bank or leasing company that technically owns your vehicle until it's paid off will absolutely require you to carry both collision and comprehensive. They're protecting their asset, the car, from being damaged or destroyed before you've paid for it. If you try to drop them, the lender will find out and they will force-place insurance on your behalf at a ridiculously inflated price and add it to your loan payment. It's non-negotiable. Second, what is your car worth? Take a look at Kelley Blue Book or a similar site and get a realistic private party sale value for your car. Now look at what you pay per year for collision and comprehensive coverage. A good rule of thumb is the 10% rule. If the annual cost of the coverage is more than 10% of your car's value, it may be time to consider dropping it. For example, if your car is worth $2,000 and the coverage costs you $500 a year, you're paying 25% of the car's total value every single year just to insure it against damage. After 4 years, you've paid the insurance company the full value of your car. In that case, it might make more sense to bank that $500 a year and self-insure. If the car gets totaled, you use the money you saved to buy another $2,000 car. But if your car is worth $20,000 and the coverage is, say, $700 a year, that's only 3.5% of its value. Dropping it to save a little cash would be an enormous, unnecessary gamble. And that brings us to the third and most important question. Can you afford to walk away? I want you to do a mental exercise. Imagine you walk out your front door tomorrow morning, and your car is just gone, stolen. Or maybe you get a call that a fire in your apartment's parking garage totaled it. Ask yourself honestly, Do you have enough cash sitting in a bank account to go out and buy a replacement vehicle tomorrow without completely derailing your finances? Not just any car, but one reliable enough to get you to work, to get your kids to school, to live your life. If the answer is no, that would be a financial catastrophe, then you need collision and comprehensive. Period. It's not just car insurance at that point. It's financial survival insurance. It's a predictable monthly payment that protects you from a sudden, unpredictable $5, $10, or $20,000 hit that you can't absorb. The fastest way to get a low-cost insurance quote is to strip it down to liability only. But as we saw with David, that low monthly premium can become the most expensive decision you ever make. The smarter way to lower your cost is to manage your collision and comprehensive coverage, not eliminate it. The secret weapon here is your deductible. A deductible is the amount you have to pay out of pocket on a claim before the insurance company pays a dime. If you have a $1,000 deductible and a $5,000 repair bill, you pay the first $1,000, they pay the next $4,000. By raising your deductible from, say, $250 to $1,000, you are telling the insurance company that you're willing to take on more of the small-scale risk yourself, and they will reward you with a significantly lower premium. So you have liability to cover your damage to others. You have collision and comprehensive to repair or replace your own car. Feels like a complete package, a fortress of financial protection. You're covered for everything, right? You would think so. But there is a massive gaping hole in this plan. A hole that has nothing to do with bent metal or broken glass. What happens to you? To your body? What happens if you can't work for 6 months because of your injuries from an accident? What about the ambulance ride, the hospital stay, the physical therapy, the mountain of medical bills that your health insurance might not fully cover? That's when you realize that insuring the car was only half the battle. Now we have to talk about protecting the most valuable thing in that car, you. And this is where the world of auto insurance gets personal. It's where a simple, low-cost decision made months or even years earlier can become the single most important financial choice of your life. We're talking about 2 specific types of coverage that are often misunderstood, frequently skipped, but can be absolute lifesavers. Medical payments coverage, often called MedPay, and personal injury protection, or PIP. These aren't about fixing your bumper. They're about fixing you. Let's imagine a scenario. Meet Sarah. Sarah is a freelance graphic designer, a classic gig economy worker. Her income is good, but it can be unpredictable. To save money, she has a high-deductible health insurance plan. Her deductible is $6,000. That means if she gets sick or injured, she has to pay the first $6,000 of her medical bills out of her own pocket before her insurance company pays a single cent. She's healthy, she's careful, so she figures it's a reasonable risk. One Tuesday afternoon, she stopped at a red light, scrolling through a podcast on her phone. The light turns green, she starts to move, and bam! The car behind her, whose driver was looking down for just a second, fails to stop and bumps her from behind. It's not a huge crash. The bumpers are scuffed, maybe a small dent. They pull over, exchange information. Sarah feels a little shaken up, a little sore, but she tells the other driver and the police officer, "I think I'm okay." Classic common mistake. She drives home, adrenaline still pumping. But that evening, her neck starts to get stiff. The next morning, she wakes up with a throbbing headache and a sharp pain radiating down her shoulder. She can barely turn her head. This is whiplash, a very real and very common injury from even low-speed rear-end collisions. She knows she needs to see a doctor, so she goes to an urgent care clinic. They examine her, and out of an abundance of caution, they send her for x-rays and an MRI to make sure there's no serious damage to her spine. The good news? No permanent damage. The bad news? She gets the bill a few weeks later. The urgent care visit, $300. The x-rays, $400. The MRI, $2,500. Then there's the prescription for muscle relaxers and the recommendation for 6 weeks of physical therapy, twice a week at $150 a session. Let's do the math. The initial visits and scans alone are over $3,000. The physical therapy will be another $1,800. That's a total of $5,000, give or take. And every single penny of it is her responsibility because it all falls under her $6,000 health insurance deductible. Suddenly, this minor fender bender has created a $5,000 crisis for Sarah. This is money she was saving for a down payment, money she needs for rent and groceries. And to make matters worse, the other driver's insurance company is dragging its feet, saying the accident was low impact, and questioning the necessity of all these treatments. They might eventually pay, but when? in 6 months, a year. The bills are due now. This is the exact nightmare scenario that medical payments coverage, or MedPay, is designed to prevent. Think of MedPay as a small, dedicated pot of money set aside specifically for medical expenses resulting from a car accident. It's incredibly straightforward. The most important thing to know about MedPay is that it is no fault. That term is key. It means it doesn't matter who caused the accident. You, the other driver, a deer, a patch of ice, it doesn't matter. If you are injured in or by a vehicle, your MedPay coverage kicks in immediately. There's no waiting for fault to be determined. There's no arguing with the other driver's adjuster. You go to the doctor, you send the bill to your own insurance company, and they pay it from your MedPay coverage right up to the limit you chose. Those limits are typically modest, often in amounts like $1,000, $5,000, or $10,000. Now let's rewind Sarah's story. Imagine when she bought her low-cost insurance, she spent an extra, say, $5 a month for $5,000 in MedPay coverage. That's the cost of one fancy coffee. Now, when she gets into that same accident, the story changes dramatically. She goes to urgent care, gets her scans, starts her physical therapy. The bills start rolling in, but instead of panicking, she simply submits them to her own auto insurance company. They pay the first $300. They pay the $400. They pay the $2,500. They pay for every single physical therapy session, right up to that $5,000 limit. She has completely covered her health insurance deductible without spending a dime of her own savings. The financial crisis is averted. She can focus on recovering instead of stressing about how she's going to pay her rent, all for the price of a latte. But MedPay does even more. It covers not just you, but also any passengers in your car. This is huge. If your friend is in the passenger seat and gets hurt, their medical bills can be covered by your MedPay. This saves them from financial hardship and saves you from the incredibly awkward, potentially friendship-ending situation where they might have to sue you to get their bills paid. It also covers you if you're a pedestrian or a cyclist and you're hit by a car. It's portable protection. Now, in some states, you have an option that's like MedPay on steroids. It's called Personal Injury Protection, or PIP. If your state is what's known as a no-fault state, you are likely required to carry PIP. In other states, it's an optional upgrade. PIP includes everything MedPay does. It covers medical bills for you and your passengers regardless of fault. But it adds two incredibly powerful benefits. The first, and most important for someone like Sarah, is lost wages. MedPay pays for your doctor bills. PIP pays for your doctor bills, and it can replace a portion of the income you lose because you're too injured to work. For an hourly worker, a gig worker, or a small business owner, this is a complete game changer. If Sarah's whiplash was so bad that she couldn't sit at a computer for 2 weeks, she would have lost 2 weeks of income. MedPay wouldn't help with that. But PIP could pay her, for example, 80% of her documented lost earnings, keeping her financially afloat while she recovers. The second major benefit of PIP is coverage for essential services. This is a benefit most people don't even know exists. Let's say you're a single parent and you break your leg in an accident. You can't drive your kids to school, you can't do the laundry, you can't clean the house. PIP can provide money to hire someone to help with those essential daily tasks that you're temporarily unable to perform. It helps keep your entire life from grinding to a halt because of an injury. So the inevitable question arises. I have great health insurance with a low deductible. Why on earth would I pay extra for MedPay or PIP? It's a fair question, but there are compelling answers. First, as we mentioned, it's for your passengers. Your health insurance covers you and only you. It does nothing for your friends, your coworkers, or your family members if they're injured while riding with you. Having even a small amount of MedPay can be an act of profound responsibility and care for the people you invite into your car. Second, speed. MedPay and PIP pay now. Even in a clear-cut case where the other driver is 100% at fault, it can take months, sometimes over a year, for their insurance company to finally settle and write you a check. In the meantime, medical providers want to be paid. They will send you to collections, potentially ruining your credit, while you wait for the insurance companies to sort it out. MedPay and PIP bridge that gap, paying your bills immediately and keeping your finances intact. And third, it fills the gaps. Your health insurance might not cover everything. It might not cover dental work if you chip a tooth on the steering wheel. It might not cover an ambulance ride. It won't cover funeral expenses, a grim but necessary consideration. MedPay and PIP are specifically designed for the unique costs of a car accident and can cover these things when your health plan won't. The bottom line is this. When you're shopping for low-cost insurance, it is incredibly tempting to uncheck every box that isn't legally required. But declining MedPay or PIP coverage, which often costs just a few extra dollars a month, is one of the riskiest gambles you can take. You are betting that you'll never get into an accident, or that if you do, you won't be injured, or that if you are injured, your health insurance deductible is something you can easily afford to pay on a moment's notice, or that you'll never have an injured passenger in your car. That's a lot of bets to win. Adding just $5,000 or $10,000 of this coverage is one of the highest value decisions you can make. It transforms your auto insurance from something that just protects your car into something that protects your health, your savings, and your financial future. So we've now covered how to protect your liability to others, how to protect the physical value of your own car, and now how to protect yourself and your passengers from the immediate financial fallout of an injury. We've built a solid fortress of protection, but there's a crack in the foundation. What happens when the person who hits you, the one who causes catastrophic damage and injury, has no fortress at all? What do you do when they're driving with no insurance? Or with the absolute bare minimum limits that don't even begin to cover the cost of your destroyed vehicle and your life-altering medical bills? This is the single most terrifying gap in the entire system. It's the black hole in the insurance universe that can swallow your financial life whole. Because the truth is, you can do everything right. You can be the safest driver on the road with the best policy money can buy, and one wrong move by a single irresponsible person can bring it all crashing down. So what's the answer? The answer is you. The answer lies in a part of your own policy that most people either don't have enough of, or don't even understand exists. It's your personal private fortress. It's the shield you build for yourself when everyone else on the road fails to build their own. We're talking about uninsured and underinsured motorist coverage. Let's call it UM and UIM for short. This is not liability coverage. This is not for accidents you cause. This coverage is for you. It's designed to protect you, your passengers, and your family from the two most dangerous kinds of drivers on the road: the ones with no insurance at all, and the ones with so little insurance it might as well be nothing. Let's break it down. Uninsured motorist coverage, or UM, steps in when you're hit by a driver who has zero insurance. They're driving illegally. They hit you, they cause injury, they wreck your car, and they have no policy to pay for any of it. It also typically covers you in a hit and run, when you're struck by a phantom driver who flees the scene, leaving you with the damage and no one to hold accountable. In these scenarios, instead of being left with nothing, you file a claim against your own UM coverage. Your own insurance company steps into the shoes of the at-fault driver's non-existent insurance and pays for your medical bills, your lost wages, and your pain and suffering, up to the limits you selected. Then there's its equally important twin, underinsured motorist coverage, or UIM. This is the one that trips people up, but it might be even more critical. Underinsured motorist coverage protects you when the at-fault driver does have insurance, but their liability limits are pathetically low, too low to cover the full extent of your damages. And let me tell you, this happens every single day. Imagine this scenario. Let's call her Jessica. She's a 35-year-old graphic designer, driving home from a client meeting in her reliable 3-year-old SUV that she's still making payments on. She's stopped at a red light, listening to a podcast. Suddenly, a massive jolt. A screech of metal. Her head whips back, then forward. An old sedan, clearly speeding, failed to stop and has just accordioned the entire back of her vehicle. The other driver gets out. He's apologetic, says he was looking at his phone. The police come. A report is filed. It's 100% his fault. Jessica is taken to the hospital. She has a concussion and severe whiplash. Her SUV is declared a total loss. The replacement value is $32,000. Over the next few weeks, the nightmare unfolds. Her initial hospital bills are $15,000. She needs months of physical therapy, another $10,000. The concussion is causing memory issues and headaches. She can't look at a screen, she can't work. The lost income starts piling up, another $20,000 and counting. The total cost of her bodily injuries, just the hard numbers, not even counting the pain and suffering, is quickly approaching $50,000. Then she gets the call from her lawyer. The driver who hit her had a state minimum insurance policy. In many states, that means his bodily injury liability limit is just $25,000 per person, and his property damage liability limit is a mere $10,000. Let that sink in. His insurance will pay out its maximum of $25,000 for her medical bills, leaving her with another $25,000 in bills that are now her problem. His insurance will pay out its maximum of $10,000 for her totaled SUV, leaving her to figure out how to cover the remaining $22,000 on her car loan. In an instant, because one person was cheap and irresponsible, Jessica is facing over $47,000 in debt. Her savings are gone. Her career is on hold. Her life is upended. She did nothing wrong, and yet she's on the verge of bankruptcy. This is not an exaggeration. This is the reality of underinsured drivers. But Jessica was smart. When she bought her car insurance, her agent asked her a question. For an extra $12 a month, you can add underinsured motorist coverage with limits of $100,000. She hesitated for a second but then thought, what the heck, it's the price of 2 fancy coffees. And that decision saved her. Because Jessica has underinsured motorist coverage, her own insurance company now steps in to bridge the gap. The other driver's policy paid its max of $25,000 for her injuries. Jessica's UIM coverage then kicks in and pays the remaining $25,000 of her medical bills and lost wages. Because her limit is $100,000, there's even room to compensate her for the pain and suffering she's endured. For her car, her own collision coverage would likely pay for the vehicle first, but underinsured motorist property damage, or UMPD, is designed specifically for this gap as well. That $12 a month became a financial lifeline worth tens of thousands of dollars. It was the best investment she ever made. Now let's get specific because you need to look at your own policy after watching this. UM and UIM coverages are usually broken into 2 parts: bodily injury and property damage. UM/UIM bodily injury is for people. It pays for medical expenses, physical therapy, lost income, and the intangible costs of pain and suffering for you and your passengers. UM/UIM property damage is for your car. It pays to repair or replace your vehicle if it's damaged by an uninsured or underinsured driver. A crucial note here. In many cases, if you have collision coverage, that will be your primary source for car repairs regardless of who is at fault. UMPD is often seen as an alternative for people who don't carry collision, but the rules vary wildly by state, so you have to check. Some states don't even offer UMPD. The gold standard is to have both collision and high-limit UM/UIM bodily injury. And here's a pro tip, a concept that your insurance company might not voluntarily explain to you in big, bold letters. It's called stacking. In many states, if you have multiple vehicles on your policy, you can choose to stack your UM/UIM coverage. Let's say you have 2 cars, and you have $100,000 of UIM bodily injury coverage on each one. If you choose the stacked option, you don't just have $100,000 of coverage. You have $200,000. You are allowed to add the limits from each car together to cover you in a single catastrophic accident. If you have 3 cars, you could have $300,000 of protection. Stacking costs a little more, but it is one of the most powerful and cost-effective ways to create a massive safety net for your family. Some states mandate UM/UIM coverage. You have to buy it, but in many others it's optional. You can legally reject it in writing to save a few bucks. And this is, without a doubt, one of the most dangerous financial gambles a person can take. Think about what you're betting on. You are betting that every single driver you share the road with is not only insured, but has high-quality insurance with limits sufficient to cover a devastating accident. What are the odds on that bet? Well, nationwide, about 1 in 8 drivers is completely uninsured. That's over 12%. In states like Mississippi, it's nearly 1 in 4. In Florida and New Mexico, it's 1 in 5. You are constantly surrounded by people driving 4,000-pound weapons with absolutely no financial backing. And that doesn't even count the tens of millions more who are driving with the legal minimum, the paper-thin policies that wouldn't even cover the cost of a modern bumper replacement, let alone a hospital stay. Skipping this coverage to save money is like removing the airbags from your car to reduce its weight and save on gas. It's a catastrophic failure of risk management. So I want you to do something. Right now, or as soon as this video is over, find your auto insurance policy declaration page. It's the summary of your coverages. Look for the lines that say uninsured motorist bodily injury and underinsured motorist bodily injury. First, see if you even have it. If you don't, your next call is to your insurance agent. Second, look at the limits. A common recommendation from financial experts is to have your UM/UIM limits match your own bodily injury liability limits. The logic is simple and powerful. If you believe you need $250,000 of liability coverage to protect your assets in case you hurt someone else, why on earth would you accept less than that amount of protection for yourself if someone else hurts you? You should value your own health and financial security at least as much as you value a stranger's. This coverage isn't about protecting others. It's about protecting you from the financial fallout of others' irresponsibility. It's the difference between an accident being a horrible inconvenience and an accident being the trigger for a decade of debt and despair. But this protection, as amazing as it is, primarily focuses on the fault of another driver. What happens when the fault is less clear? Or what if the accident is your fault? You still have medical bills, you still have injuries. Is there a way to get your initial medical costs covered immediately? No questions asked, without waiting for fault to be determined or for lawyers to get involved. A way to ensure the ambulance ride and the emergency room visit are paid for right away? Yes, there is. And it's one of the most misunderstood, yet powerful components of any auto insurance policy. It's the part that acts as your financial first responder. We're talking about two specific types of coverage: personal injury protection, usually called PIP, and medical payments coverage, often shortened to MedPay. Let's not get bogged down in the jargon just yet. Instead, let me tell you about two people, Sarah and Mark. They live in the same town, drive similar cars, and one Tuesday morning, they both get into nearly identical accidents. Both are sitting at a red light and boom, they get rear-ended by a distracted driver. It's not a catastrophic crash, but it's jarring. Their necks are sore, their backs are aching. The paramedics check them out and recommend a trip to the emergency room just to be safe. Both accidents are clearly the other driver's fault. This is where their stories diverge completely. Sarah, trying to keep her monthly premiums as low as humanly possible, had declined every optional coverage. She has the state minimum liability, and that's it. She thinks, the other guy is at fault, his insurance will pay for everything. So she goes to the emergency room. They do some x-rays, give her a neck brace and some muscle relaxers. A few weeks later, the bill arrives. It's for $4,700. Sarah forwards it to the at-fault driver's insurance company, and then she waits. The adjuster from the other company is slow to respond. They say they're still investigating the claim. They need to get a recorded statement from their driver, who is suddenly very difficult to reach. Meanwhile, the hospital's billing department starts calling Sarah. "Ma'am, this bill is now 30 days past due." Sarah explains the situation. They're sympathetic, but they want to be paid. Her own health insurance has a $5,000 deductible, so she can't just run it through them without paying it all herself first. The stress is immense. She's in pain from the accident, and now she's getting collection notices for a bill that isn't her fault. She's dipping into her emergency savings, the money she had set aside for a down payment on a house, just to make a partial payment to the hospital to keep them off her back. Every day is a new worry. Will the other insurance company ever pay? Will this ruin her credit? This nightmare drags on for 3 months before the other insurer finally accepts liability and sends a check. 3 months of pure financial and emotional agony, all while trying to recover from her injuries. Now let's look at Mark. Mark's accident was the same, rear-ended at a red light. He also went to the emergency room, but Mark had a small $5,000 MedPay coverage on his policy. It cost him an extra $6 a month. At the hospital, when they asked for insurance, he didn't give them the other driver's information. He gave them his own. His insurance company paid the $4,700 hospital bill immediately. No questions asked. No waiting for the other driver's adjuster. No investigation into fault. The bill was just handled. Mark never got a single call from the hospital's billing department. He never had to touch his savings. He was able to focus 100% on his physical therapy and getting better. What happened behind the scenes is the magic of this coverage. Mark's insurance company, after paying his bill, then went after the at-fault driver's insurance company to get reimbursed. This is a process called subrogation, but that battle happened between two giant insurance companies, with their teams of lawyers and adjusters. It was completely invisible to Mark. He was shielded from the entire stressful, drawn-out process. For $6 a month, he bought himself peace of mind. He bought himself the ability to get medical care without having to become a bill collector. That is the profound difference. PIP and MedPay are no-fault coverages, which means they pay out for your medical expenses regardless of who caused the accident. They are your immediate safety net. Let's break them down. In about a dozen states known as no-fault states, think Florida, Michigan, New York, among others, personal injury protection or PIP is mandatory. The whole idea in these states is to prevent a flood of lawsuits and ensure that everyone gets immediate medical care. If you live in one of these states, your own PIP coverage is your first line of defense for medical bills up to your policy limit. PIP is also broader than MedPay. It doesn't just cover doctor and hospital bills. It can also cover lost wages if you can't work because of your injuries, and even things like hiring someone to help with household chores if you're laid up. It's comprehensive protection for the immediate aftermath of a crash. In the rest of the country, the at-fault states, you typically have the option to add medical payments coverage, or MedPay. MedPay is simpler than PIP. It strictly covers medical and funeral expenses for you and any passengers in your car. It won't cover lost wages, but it's incredibly valuable for its primary purpose, paying those initial medical bills right now. Many people make Sarah's mistake. They think, I have good health insurance. Why would I need MedPay? This is one of the most dangerous misconceptions in insurance. First, as we saw with Sarah, think about your health insurance deductible. Is it $1,000? $5,000? $10,000? If you get in an accident, you will have to pay that amount out of your own pocket before your health insurance kicks in a single penny. MedPay, on the other hand, often has no deductible. It pays from the very first dollar. It can literally pay your health insurance deductible for you. Second, your health insurance might not cover everything. It might not cover certain types of chiropractic care, dental work if you chipped a tooth in the crash, or an ambulance ride. MedPay often does. And third, MedPay covers your passengers too. Are you going to ask your friend who was riding with you to cough up their $5,000 health insurance deductible because someone else hit your car? Having MedPay or PIP avoids that incredibly awkward and potentially friendship-ending situation. Protects the people you care about who are in your car. And the cost? This is the best part. For what it does, it's one of the cheapest coverages you can buy. For many drivers, adding $5,000 or $10,000 of MedPay coverage might only increase their premium by the cost of a couple of coffees a month. It is, without a doubt, one of the highest value purchases you can make in the entire world of insurance. You are trading a few dollars a month to protect yourself from thousands of dollars in immediate, out-of-pocket debt and months of agonizing stress. It's the difference between Sarah's nightmare and Mark's peace of mind. This is the essence of building a smart, low-cost insurance plan. It isn't just about finding the lowest possible number. It's about understanding where a small strategic investment can save you from financial ruin. It's about identifying the most devastating risks and neutralizing them for just a few dollars. The risk of getting into a minor accident and being stuck in billing limbo is incredibly high. The cost to completely eliminate that risk is incredibly low. So you've covered yourself. You have liability to protect your assets if you cause an accident. You have collision and comprehensive to fix your own car. And now you have PIP or MedPay to handle your immediate medical bills and insulate you from financial stress while you recover. You're feeling pretty protected, right? But what happens if the person who hits you has no insurance at all? Or they have the bare minimum state liability that doesn't even come close to covering your total $15,000 car and your $50,000 medical bills? You did everything right, you bought all the smart coverages, but you're hit by someone who has nothing. Are you just out of luck? Is there a safety net for that nightmare scenario? The short answer is yes. There is a safety net, and it's one of the most tragically misunderstood and criminally underpurchased coverages on any auto insurance policy. It's called uninsured and underinsured motorist coverage. And frankly, it might be the single most important protection you can buy that isn't mandated by law. Think of it this way, all the liability coverage we've talked about is for damage you do to others. This coverage, this is for you. This is the insurance you buy to protect yourself from the millions of drivers who are either breaking the law with no insurance, or who bought the cheapest policy they could find that barely covers a fender bender, let alone a serious accident. Let's go back to that nightmare scenario. You're sitting at a red light, minding your own business. The light turns green. You start to pull forward and BM. Someone blows through their red light at 50 miles an hour and T-bones you. Your car is a twisted wreck. You're rushed to the hospital with a broken femur and a serious concussion. Your medical bills start piling up, the ambulance, the emergency room, the surgery, the physical therapy. You're out of work for 3 months. Your $10,000 car is totaled, your medical bills hit $50,000, and your lost wages are another $15,000. Total damages, $75,000. The police report comes back. The other driver was 100% at fault. A small sigh of relief. But then the second piece of news hits you like a punch to the gut. The driver who hit you has no insurance. Zero. They let their policy lapse months ago. Or maybe it's a hit and run, and you never even find the driver. So who pays for your $75,000 in damages? This is where uninsured motorist bodily injury, or UMBI coverage, becomes your financial superhero. It steps into the shoes of the at-fault driver's insurance company, the one that doesn't exist. Pays for your medical bills, pays for your lost wages. It can even pay for your pain and suffering. It makes you whole again, just as the other driver's insurance was supposed to. Without it, you're on your own. You could try to sue the driver personally, but let's be realistic. If they can't afford a basic insurance policy, the odds of them having $75,000 sitting in a bank account are practically zero. You'd win a piece of paper, a judgment that's completely worthless. Now let's change one small detail in that story. The at-fault driver does have insurance, but they bought a state minimum policy. Let's say their bodily injury liability limit is $15,000 per person. That's all their insurance company is legally required to pay you. So they write you a check for $15,000. Great, but your medical bills and lost wages are $75,000. You are still $60,000 in the hole. This is where the second half of this dynamic duo comes in. Underinsured motorist coverage, or UIM. Your UIM coverage kicks in after the other driver's insurance pays out its maximum. It covers the difference, the gap between their pathetic limit and your actual damages, all the way up to the UIM limit you selected on your own policy. So uninsured covers you when they have nothing. Underinsured covers you when they have something, but it's not nearly enough. Together, they form a shield that protects you from financial ruin caused by someone else's irresponsibility. And don't for a second think this is a rare 1-in-a-million scenario. The Insurance Research Council estimates that 1 in every 8 drivers on the road in America is uninsured. 1 in 8. In some states, it's as high as 1 in 4. That means on your average commute, you will pass dozens, if not hundreds, of drivers who have absolutely no way to pay for the damage they could cause to you and your family. Relying on other people to do the right thing and carry proper insurance is a massive gamble. UM and UIM coverage is how you take luck out of the equation. Now, this coverage typically comes in 2 flavors: bodily injury and property damage. We've been talking about bodily injury, which covers people. The other is uninsured motorist property damage, or UMPD. This is designed to repair or replace your car if it's damaged by an uninsured driver. But here's a pro tip. If you already have collision coverage on your policy, UMPD can be redundant. Remember, collision pays to fix your car regardless of who is at fault, even if it's a hit and run. UMPD often has its own separate deductible and might not even be offered in every state. If you're on a tight budget and have to choose 99 times out of 100, you should prioritize having collision coverage for your car and maxing out your uninsured motorist bodily injury coverage for your health. Cars are replaceable. Your ability to walk, to work, to live without pain is not. So how much should you get? My advice is simple. You should carry at least as much uninsured motorist coverage as you have bodily injury liability coverage. If you have a $100,000–$300,000 liability limit to protect your assets from others, you should have a $100,000–$300,000 UM/UIM limit to protect your assets from being destroyed by others. It is a mirror. It is a reflection of how much you value your own financial and physical well-being. And for those of you with more than one car on your policy, there's a powerful feature you need to know about called stacking. Not all states offer it, but if yours does, it's a game changer. Stacking allows you to combine the uninsured motorist limits for each car on your policy. Let's say you have 2 cars, and each one has a $50,000 UM limit. If you have stacked coverage and you get into an accident, you don't just have $50,000 of protection. You can stack them together, giving you a total of $100,000 in coverage. If you have 3 cars, it triples your coverage. It's an incredible way to multiply your protection for what is usually a very small increase in your premium. Always ask your agent if stacking is available. I know what some of you are thinking. This is a series about low-cost insurance. Why am I telling you to add more coverage and potentially pay more? Because being low-cost is not the same as being cheap. A cheap policy is one that fails you when you need it most. A truly low-cost policy is one that provides the absolute maximum protection against financial catastrophe for the most efficient price. And dropping your UM/UIM limits to save $10 a month is the definition of false economy. It's like removing the airbags from your car to save a little money on the sticker price. It's a disaster waiting to happen. This coverage is the airbag for your entire financial life. It is, without a doubt, one of the smartest, most valuable dollars you will ever spend on insurance. Okay, so your UM/UIM policy is in place. You're protected from the devastating long-term financial fallout of an uninsured driver's mistake. Your massive hospital bills, your months of lost income, there's a plan for that. But what about the immediate aftermath? What about the $5,000 emergency room bill that arrives in the mail next week? The health insurance deductible you have to pay up front right now just to get treatment? Who pays for that right now before fault is even determined? Is there a type of coverage designed for that instant financial first aid? Yes, there is. And it's arguably the most important, most misunderstood, and most criminally underrated coverage you can have on your policy. It's the coverage that acts like a paramedic for your wallet. It doesn't wait for blame, it doesn't wait for court dates, it doesn't wait for investigations. It shows up right when you need it, right at the scene of your financial emergency. We're talking about what's known as first-party benefits, specifically personal injury protection or PIP, and its close cousin medical payments coverage or MedPay. Let's go back to that hospital room. The adrenaline has worn off, and the dull, throbbing pain is setting in. A hospital administrator with a clipboard and a sympathetic but firm expression is explaining your financial responsibility. You have health insurance, thank God, but they're talking about your $2,000 deductible. Then your 20% coinsurance after that. The numbers are making your head spin faster than the accident did. You need to pay that deductible now to get the scan the doctor ordered. But you don't have $2,000 just sitting there. The rent is due. The car payment is coming. This is the moment of truth. This is where the type of auto insurance you chose months or years ago suddenly becomes the most important financial decision of your life. If you have personal injury protection, the conversation changes. PIP is your own auto insurance policy's health coverage for a car accident. And its superpower is that it is no fault. That term is key. No fault doesn't mean no one is to blame for the accident. It means that when it comes to your immediate medical needs, it doesn't matter who is at fault. Your own insurance company steps up to pay for your injuries right away, up to your policy limit. You're not waiting for the other driver's insurance company to conduct a 3-month investigation. You're not arguing with their adjuster, who is trained to minimize their payout. You're not draining your savings account to cover your health insurance deductible. You simply give the hospital your auto insurance policy number, and the PIP coverage kicks in. It's designed for this exact moment of crisis. The bill for the ambulance ride? PIP can cover it. The emergency room visit? Covered. The x-rays, the CT scan, the prescription for painkillers? Covered. But here's where it gets even more powerful. PIP isn't just medical insurance. It's disaster insurance. Its benefits go far beyond the hospital walls. The single biggest financial threat from a serious injury isn't always the medical bills themselves. It's the loss of your ability to earn a living. Let's say you're a contractor, a waitress, a freelance graphic designer, or anyone who doesn't get paid if you don't work. The doctor says you can't go back to work for 6 weeks because of your injuries. Your regular health insurance does absolutely nothing about that. It won't pay your rent. It won't buy your groceries. It won't keep the lights on. Your sick leave runs out in a week. Then what? This is where PIP becomes a literal financial lifesaver. A major component of most PIP plans is reimbursement for lost wages. If you're out of work because of a covered accident, PIP will pay you a percentage of your lost income, typically up to a certain weekly or total limit. Imagine that for a second. While you're recovering, a check still arrives. It's not your full paycheck, but it's enough to keep your life from completely unraveling. Buys you time. It buys you breathing room to heal without the crushing weight of impending bankruptcy. And it doesn't stop there. What if you're a stay-at-home parent, and now you can't take care of your children because of your injuries? PIP can cover the cost of replacement services, like hiring someone for childcare. It can cover the cost of house cleaning if you're physically unable to do it. In the absolute worst-case scenario, it even provides a death benefit to help cover funeral expenses, easing the burden on a grieving family. Now you might be thinking, this sounds amazing, why doesn't everyone have it? Well, in about a dozen states known as no-fault states, places like Florida, Michigan, New York, and others, you are required by law to carry PIP. The system is designed this way to keep smaller injury claims out of the court system and ensure everyone gets immediate medical care. But what if you don't live in a no-fault state? You likely have the option to buy medical payments coverage or MedPay. You can think of MedPay as PIP's younger, more streamlined sibling. It also covers medical expenses for you and your passengers regardless of who is at fault. It's that same instant financial first aid. If you and your friends are in a car accident, MedPay can pay for all of your emergency room copays. It works just like PIP for medical bills, paying quickly without the hassle of determining fault. The key difference is that MedPay is typically limited to just medical and funeral expenses. It does not cover lost wages or replacement services. Its coverage limits are also generally lower than PIP, often ranging from $1,000 to $10,000. While that might not sound like a lot in the face of major surgery, having $5,000 of MedPay to instantly cover your health insurance deductible and initial copays can be the difference between getting immediate care and having to make impossible financial choices in a hospital waiting room. So why would you get MedPay if you already have good health insurance? It's a fantastic question, and the answer reveals the true value of this coverage. First, the deductible. As we discussed, your health insurance deductible could be thousands of dollars. MedPay can pay that deductible for you. You get into an accident, your health insurance has a $2,500 deductible, but you have $5,000 in MedPay. You effectively pay nothing out of pocket for your initial care. Second, your passengers. What if your friend in the passenger seat doesn't have health insurance? Or has a terrible high-deductible plan? Your MedPay covers them. It protects the people you care about who are riding in your car, preventing an already awful situation from becoming an awkward and friendship-straining financial dispute. Third, coverage gaps. Some health insurance plans don't cover certain treatments that are common after a car accident, like chiropractic care, acupuncture, or specific types of physical therapy. MedPay and PIP often will. And fourth, even if you're a pedestrian or a cyclist, if you have MedPay or PIP on your auto policy, and you are struck by a car while you're out for a walk or a bike ride, your own auto insurance can step in to cover your medical bills. The cost for this peace of mind is often shockingly low. Adding a meaningful amount of MedPay or PIP to your policy might cost as little as a few dollars a month. It is one of a handful of coverages that is an absolute no-brainer. It's a small fixed cost that protects you from a sudden, catastrophic, and unknowable cost. It's buying certainty in a world of uncertainty. So we've built a pretty solid fortress now, haven't we? We have liability coverage to protect our assets if we cause an accident. We have collision and comprehensive to fix or replace our own car, no matter what happens to it. And now we have PIP or MedPay to provide instant medical and financial relief for ourselves and our passengers, regardless of who was at fault. Seems like we've covered all the bases. You've done everything right. You've been a responsible driver and a savvy consumer. You are protected. But there's one more scenario, one more variable out on the road that can render almost all of this planning useless. It's the phantom menace of the highway, the driver who operates completely outside the system. What happens when the person who T-bones you at an intersection, the person who is clearly 100% at fault, has nothing? No insurance, no driver's license, no assets to their name. They get out, look at the damage, and then they just run. Or they stay, and when the police arrive, they just shrug and say, "I don't have insurance." All your preparation, all your responsible planning, was designed for a system where everyone plays by the rules. But what happens when you're hit by a ghost? Is your entire financial life now at the mercy of someone who has nothing to lose? How do you protect yourself from the uninsured? The answer is, you become your own safety net. You build a fortress around your finances, not with concrete and steel, but with 2 or 3 specific lines on your insurance policy that most people either ignore or actively remove to save a few dollars a month. This is the single biggest mistake a budget-conscious driver can make. Let's go back to Sarah, standing on the side of the road, watching the tow truck haul away her crumpled car. The police officer hands her a slip of paper with the other driver's information, or rather, the lack of it. The name is likely fake. The address, a vacant lot. The insurance slip they handed over? A worthless, expired piece of paper. The other driver has vanished. They are a ghost. Sarah's liability insurance, the one the state required her to have, is now completely useless. It was designed to pay for damage she caused, not for damage done to her. Her collision coverage will eventually pay to fix her car, but only after she pays her $1,000 deductible. But what about her body? Her neck is stiffening. Her arm is throbbing. The paramedic at the scene recommended a trip to the emergency room, an ER visit, an X-ray, a follow-up with a specialist. The bills are going to pile up faster than she can imagine. And who pays for that? The ghost? No, she does. Who pays for her lost wages when the doctor tells her she can't work for 2 weeks? She does. This is the nightmare scenario. This is where the quest for the absolute cheapest insurance policy leads you. to a cliff's edge with no guardrail. But there is a guardrail available. It's called Uninsured Motorist Bodily Injury Coverage, or UMBI. Think of it as a clone of the ghost driver's insurance policy that you buy for yourself. When a driver with no insurance hits you and hurts you, your own insurance company steps in and acts as if they were the at-fault driver's insurer. They pay for your medical bills, your physical therapy, your lost income, and even for your pain and suffering up to the limits you selected. You are essentially insuring yourself against the irresponsibility of others. And then there's its twin brother, Underinsured Motorist Coverage, or UIM. This is for when the other driver isn't a ghost, but they might as well be. They have insurance, but it's the bare-bones state minimum policy we've been talking about. Let's say they have a $15,000 bodily injury liability limit, but your medical bills after a serious accident are $80,000. Their insurance pays the first $15,000 and then that's it. They're done. You're left with a $65,000 hole. This is where underinsured motorist coverage kicks in. It covers the gap between what the other driver's policy paid and what your actual damages are. Again, up to the limits you chose. Together, UM and UIM are your shield. And in many states, you can also get uninsured motorist property damage, which helps pay to fix your car if an uninsured driver hits you, often with a much lower deductible than your standard collision coverage. Given that 1 in 8 drivers on the road has no insurance, and many more have the absolute minimum, driving without this coverage is like walking into a sword fight wearing a paper shirt. You're trusting your entire financial future to the hope that every other driver out there is as responsible as you are. And that, my friends, is a terrible bet to make. You might be thinking, okay, this sounds important, but this video is about low-cost options. This has to be expensive, right? You would be surprised. Because the risk is spread out among all policyholders, adding robust UM/UIM coverage is often one of the most affordable additions you can make. We're often talking about the price of a couple of fancy coffees per month, a few dollars to protect yourself from a potential $100,000 catastrophe. There is no better return on investment in the entire world of insurance. When you call your agent, you shouldn't ask if you should have it. You should ask them to quote you limits that match your own liability coverage. If you're protecting other people from your mistakes with $100,000 of liability, why would you protect yourself and your family with any less? But there's one more piece to this puzzle. One more layer of protection that operates on a completely different level, and it is arguably just as critical. It's called medical payments coverage, or MedPay. In some states, it's a more comprehensive version called personal injury protection, or PIP. Here's the magic of MedPay and PIP. It is no fault. It doesn't matter who caused the accident. It doesn't matter if it was a ghost driver, a billionaire, or a deer that jumped in front of your car. If you are injured in or by your vehicle, this coverage kicks in immediately to pay for your medical expenses. Think about the timeline of that accident with the uninsured driver. Your UM coverage will eventually pay your medical bills, but first there has to be a claims process. It has to be established that the other driver was at fault and that they were, in fact, uninsured. This can take time, weeks, even months. In the meantime, the hospital wants its money. The ambulance company is sending you letters. Your health insurance has a massive deductible you have to meet first. It's a stressful cash flow nightmare. MedPay is the first responder. It's the cash in your pocket. Pays that ER bill now. It covers your health insurance deductible now. It pays for the ambulance ride, the dental work if you injured your teeth, even health services not always covered by traditional insurance like chiropractic care. And it covers not just you but every passenger in your car. It's typically sold in smaller amounts, $1,000, $5,000, $10,000, and it is incredibly inexpensive. Adding $5,000 of MedPay coverage might cost you less than $1 a month. It is the ultimate peace of mind purchase. It ensures that no matter what happens, you can get immediate medical care without worrying about the upfront cost. So let's put this all together. The journey to smart, affordable auto insurance isn't about stripping your policy down to the studs. That's not being frugal, it's being fragile. A truly low-cost policy is one that costs you the least amount of money over your lifetime, and that includes the cost of a potential accident. The goal is to build a smart, resilient policy that protects you from the most common and devastating financial risks, while trimming the fat elsewhere. It means starting with a liability limit that actually protects your assets and your future earnings, not just the legal minimum. It means choosing a deductible on your comprehensive and collision coverage that you can comfortably afford to pay tomorrow without going into debt. It means never ever for any reason, driving without uninsured and underinsured motorist coverage that mirrors your own liability limits. And it means adding a layer of medical payments or personal injury protection to serve as your immediate financial first aid kit. This is how you win the game. You don't win by finding the absolute rock bottom premium. That's a fool's errand that leaves you exposed. You win by understanding the risks and strategically building a policy that addresses them for the best possible price. You raise your deductibles on the physical damage to your car, and you use those savings to buy more liability and uninsured motorist protection for your body and your life. You shop around not just for the cheapest price, but for the company that offers the best value for this kind of smart defensive coverage. So here is your mission should you choose to accept it. Sometime in the next 48 hours, I want you to pull out your own auto insurance policy. Don't just look at the price. Look at the declaration page. Find the line that says, Uninsured Motorist Bodily Injury. What are those numbers? Are they the state minimum? Or do they match the liability coverage you have for others? Find the line for medical payments. Does it even exist on your policy? If you can't find these, or if the numbers are terrifyingly low, your homework is to make one phone call. Just one. Call your agent or your insurance company. Don't tell them you want to lower your bill. Tell them you want a quote to increase your uninsured motorist and MedPay coverage. Ask them what it would cost to raise your UM/UIM to 50/100 or 100/300. Ask what it would cost to add $5,000 of MedPay. The answer will probably shock you with how affordable it is. For the price of a few lunches a month, you can close the biggest, most dangerous loopholes in your financial life. You can build a fortress, because at the end of the day, car insurance isn't about fixing your car. It's about making sure that one bad day on the road doesn't derail the rest of your life. The cheapest policy is the one that's there for you when the ghost driver comes calling. The most expensive policy in the world is the one you thought was a bargain, right up until the moment you actually needed it. Protect yourself. Make the call.